Intermediate Accounting, Chapter 6, Appendix. Chapter 6, Revenue Recognition. After studying this Appendix 6A, you should be able to 12. Apply the percentage of completion method for long-term contracts. 13. Apply the zero profit method for long-term contracts. 14. Apply the completed contract method for long-term contracts. 15. Account for losses on long-term contracts. Long-term contracts, one of two. Depending on the structure of a contract, revenue can be recognized at a single point in time or over a period of time. Under IFRS, a company can recognize revenue over time if it can reasonably estimate its progress towards completion and meets at least one of the following criteria. 1. The customer receives and consumes the benefit as the seller performs. 2. The customer controls the asset. 3. The company does not have an alternative use for the asset and has a right to payment for its performance. If none of the criteria are met, then revenue is recognized at a point in time. ASPE guidance is very general. Revenue recognized must reflect the work accomplished. Long-term contracts, 2 of 2. As work progresses, a long-term contract might be viewed as a continuous sale. The amount of revenues, costs, and gross profit recognized on long-term contracts depends upon the extent of progress towards satisfying the obligation. Revenue recognized each period is based on performance up to that point. The rationale for using this method is that throughout most of these contracts, both the buyer and the seller have enforceable rights. Buyer has the right to specific performance. The seller has the right to progress payments. Percentage of completion, 1 of 2. Percentage of completion is one method for measuring the progress towards satisfying an obligation. Application of the percentage of completion method requires a basis for measuring the progress at particular interim dates. 2 kinds of measures. Input measures. Efforts devoted to the contract. Costs incurred, labor hours worked. Disruptions in the input unit and productivity relationship can lead to measurement anomalies. Front-end loading might lead to higher estimates of completion. Output measures. Track results, tons produced, highway kilometers built, inaccurate results if units are not uniform. Percentage of completion, 2 of 2. The most popular input measure when using the percentage of completion method is the cost-to-cost basis. Formula for percentage of completion cost-to-cost basis. Costs incurred to date divided by most recent estimate of total costs equals percent complete. Apply this percentage to the estimated total revenue or gross profit to determine the amount recognized to date. Percent complete multiplied by estimated total revenue or gross profit equals revenue or gross profit to be recognized to date. To find the amount of revenue or gross profit to be recognized each period, take the revenue or gross profit to be recognized to date minus the revenue or gross profit recognized in prior periods equals current period revenue or gross profit. Percentage of completion cost-to-cost basis example, 1 of 3. Assume that Hard Hat Construction Company has a non-cancelable contract to construct a $4.5 million bridge at an estimated cost of $4 million. The contract is to start in July 2020 and the bridge is to be completed in October 2022. The following data pertain to the construction period. Assume that progress billings are non-refundable. Costs to date, December 31st, 2020, $1 million, 2021, $2.916 million, 2022, $4.05 million. Estimated cost to complete, December 31st, 2020, $3 million. 2021, $1.134 million. 2022, 0. Progress billings during the year, 2020, $900,000. 2021, $2.4 million. 2022, 1.2 million. Cash collected during the year, 2020, 750,000, 2021, 1.75 million, 2022, 2 million. How would the percentage of completion be calculated? Percentage of completion cost to cost basis, 2 of 3. First, calculate the percentage complete at the end of each year. So we'll use 2020 as the example. Contract price, 4.5 million. Less estimated cost. Cost to date, 1 million. Estimated cost to complete, 3 million. Estimated total costs, 400,000. Estimated total gross profit, 500,000. Percent complete, 25%. So if you take the 1 million divided by the 4 million, that's how you get the 25%. Note that by the end of 2021, Hard Hat has revised the estimated total cost from 4 million to 4.05 million. Percentage of completion cost to cost basis, 3 of 3. How much gross profit should be recognized each year? So we'll just use 2020 as the example again. So to date, revenues, 4.5 million times 25% is 1.125. Costs, 1 million. Gross profit, 125,000. Recognized in prior years, 0. Recognized in current year, 1.125, 1 million, and 125. How is this information recorded? Percentage of completion cost to cost basis journal entries. 1. As they occur, construction costs are accumulated as debits in a contract asset liability account, and then credit accounts payable. So the contract asset or liability, 1 would be 1 million. 2. As they occur, billings are credited to the contract asset liability account, debit accounts receivable. So 2 would be 900,000. 3. At the end of the period, the cost of construction for that period is taken out of the contract asset account and debited as construction expenses. So 3 would be the credit to 1 million. 4. At the end of the period, when revenue is recognized, it is taken out of the contract asset liability account and credited to revenue from long-term contracts. So 4, 1.125 million. 5. The ending debit balance is recorded on the statement of financial position. So that would be the debit of 225,000. Percentage of completion financial statement presentation, 1 of 2. The contract asset liability account is reported at net on the statement of financial position. If the balance is a debit, it is reported as an asset. Accounts receivable, revenue recognized is greater than amount billed. If the balance is a credit, it is reported as a liability. Unearned revenue, amount billed is greater than revenue recognized. When reporting contract accounts on the financial statements, they are classified as follows. Contract asset/liability is current, as long as the related revenues will be earned in the following year. Accounts receivable are current, assuming they will be received within the following year. Percentage of completion financial statement presentation, 2 of 2. Partial income statement and statement of financial position for Hard Hat Construction for 2020 under the percentage of completion method. Hard Hat Construction Company 2020. Revenues, 1.125 million. Construction expenses, 1 million. Gross profit, 125,000. Balance sheet, December 31st for 2020. Current assets, accounts receivable, 150,000. Contract asset net, 225,000. Contract asset of 225,000 represents the difference between the amount of revenue that has been recognized and the amount that has been billed. So it's the 1.125 minus the 900,000. By the end of the contract, the balance in the contract asset or liability account will be zero. Zero profit method. Under IFRS, if a company is uncertain about the outcome of a contract, they have to recognize revenue using the zero profit method. With this method, recoverable revenues equals costs until the uncertainty is resolved. The company must be confident it will recover costs incurred in order to use the zero profit method. Using the hard hat construction example, 2020, revenues 1 million, costs 1 million, gross profit 0. 2021, revenues 1.916 million, costs 1.916 million, gross profit 0. 2022, revenues equals 1.584 million to bring total to 4.5 million. Costs equals 1.134 million to bring the total to 4.050 million. The gross profit equals 450,000. Journal entries are the same as percentage of completion, except revenue equals costs in the first 2 years. Completed contract method. Under ASPE, if a company is uncertain about the outcome of a contract or the performance consists of a single act, they would use the completed contract method to recognize revenues. Revenues, expenses, and gross profit are recognized upon completion of the contract. Some companies use the construction and process account instead of the contract asset/liability account. Advantage. Reported revenue is based on actual results, not estimates. Disadvantage. Does not reflect current performance when the contract is longer than 1 year. It creates a distortion of earnings. All journal entries are the same as the percentage of completion method, except that no revenue or construction expenses are recognized until the final year of the contract. Comparison of results, gross profit recognition. The table below compares the amount of gross profit recognized by hard hat construction under the 3 different methods of revenue recognition. So in 2020, percentage of completion, we recognized 125,000, zero profit and completed contract 0. In 2021, under percentage of completion, we recognized 199,000, zero profit and completed contract, we recognize 0. In 2022, percentage of completion, we recognize 126,000, and under zero profit and completed contract, we recognize 450,000. Long-term contract losses. There's 2 types of losses that can occur under long-term contracts. Loss in the current period on a profitable contract. There is a significant increase in total contract costs, but the increase does not eliminate all the profits. Under percentage of completion, an adjustment in the current period has to be made for the excess gross profit recognized in previous periods. No adjustment for other 2 methods because there is no gross profit recognized until the final year. An overall loss on an unprofitable contract. Under all 3 methods, the entire loss that is expected on the contract must be recognized in the current period. Loss in current period. Profitable contract example. Assume the same facts for hard hat construction in previous examples, except on December 31st, 2021, end of year 2, the costs to complete the contract are revised to 1468962 from 1134000. The calculations for 2020 would be the same as before, so the gross profit is 125,000. The calculations for 2021 would change. So you would have your costs to date, 2916000, your estimated cost to complete revised, 1468962, estimated total costs, 4384962, your percent to complete is 66.5%. The revenue recognized in 2021 would be the 4.5 million times 66.5%, minus the 1125000, so that will give you 1867500. Your costs incurred to 2021 is 1916000. The loss to be recognized in 2021 is 48,500. So you would debit construction expense 1916000, credit contract asset or liability for 48500, and credit revenue from long-term contracts 1867500. Loss in current period unprofitable contract example 1 of 3. A contract becomes onerous when the total estimated costs exceed the total revenues. Under the percentage of completion method, revenues recognized in previous periods must be reversed, and the total estimated loss must be recognized in the current period. Under the zero profit and completed contract methods, because no revenue has been recognized, nothing has to be reversed, but the total estimated loss has to be recognized in the current period. Loss in current period unprofitable contract example 2 of 3. Using Hard Hat Construction Company, assume that at December 31st, 2021, the costs to complete the bridge contract are estimated to be 1640250 instead of 1134000. The $125,000 of gross profit Hard Hat recognized in 2020 must be offset in 2021 because it no longer expected to be realized. In addition, since losses must be recognized as soon as estimable, the company must recognize the total estimated loss of 56250 in 2021. Therefore, Hard Hat must recognize a total loss of 181,250, which is the 125,000 plus 56250 in 2021. So you have the contract price, $4.5 million, estimated total cost, $455,650 to give you your gross profit, or in this case, loss for the contract, $56250.